We've seen the Aussie dollar down about 5% since the highs of about 80 cents in February. We've seen just an overall calm when it comes to the bond market as well, not just, of course, in Australia. Does this last, though? What is this window of opportunity for the RBA today?
Well, I don't think you'll actually hear that much more from the RBA beyond what they've been saying for the last few weeks. That is, the economy is improving, that they are seeing some improvement in the labour market. I think it's looking like it's getting back on track. And that's great from the near term, but they must balance that out against those longer term pressures which are weighing on inflation and the fact that we are still some way from what they view as a full employment and some way from what they view would be a level of wage growth, which would create that inflation. So the message will be very much staying the course and the need to act to do more on QE or to support the economy if needed. And there may even be some mention of the fact that some of these fiscal support measures will be rolling off in the coming months in Australia, which actually may lead to a period of slightly softer growth than be expected. So I think that'll be quite balanced in that view. And then again, thinking about some of the financial stability aspects of what we're seeing in the housing market, obviously the wealth effect from higher house prices being quite good for consumption versus whether the housing market is getting a bit too hot. So I think there'll be a very balanced statement from the RBA today around that. And that the markets won't be too surprised unless there is some sort of announcement about an extension to yield curve control, which we think is probably a few months off.
Kerry, when it comes to the equity market, is there anything that's going to move the needle? I mean, is there anything that's going to move the needle beyond even the RBA when it comes to Aussie equities, which just tend to, for the large part, trade sideways?
Well, I think most of the focus now in terms of the equity market has to be on earnings growth. I mean, last year was about a re-rating in terms of what we saw in PEs. We've actually seen valuation multiples come down. The Australian market's now trading at around 18 times. It has to be about the earnings growth to support that and see that valuation come down a little bit. I think that's where we're looking at earnings revisions around the world and seeing the rest of the world being slightly better than what we're seeing in Australia. And that's will be a big factor in terms of thinking about how equities will perform, especially as we consider this rotation continuing into cyclical sectors, into value, and where the Australian market stands relative to others. And I do believe that it'll be the others that actually stand out in terms of Japan, Europe, and the catch-up we expect later in the year in those economies relative to what we've already seen in Australia, which has pretty much lagged in the first quarter, and we think will probably continue to be that way.
Yeah, we've heard more positive calls on Japan lately, especially because of their cyclical nature. As this GTV chart on the Bloomberg also shows, we continue to see Japanese yen weakness. Now, this showing the dollar around overbought levels against the yen already. So how much more upside could we expect in this market, and what do you like there?
Again, it is thinking about that rotation that it's continuing to push through, and that rotation into those cyclical sectors naturally push usually towards those markets with a bigger cyclical weight, which is Europe and Japan. I mean, Japan has some risks around how they've handled the coronavirus pandemic, the cases they've seen there, the vaccine rollout. But by and large, this is a market with a large beta to the rest of the world and should benefit from that if we think about the autos, we think about some of the cyclical sectors there. I mean, the concern is obviously financials and what we're seeing with banks, the impact of further negative rates and that would have on the outlook there. So it always is concerning there. But I think if you play those markets or those parts of the market which really are in tune with what's going to happen globally, this would be a market that will continue to perform. And the currency, I think, is another aspect to consider in terms of it hasn't behaved as perhaps was being expected this year. And we may also see that shift later in the year again as some of the US dollar strength starts to turn to a bit more of a US dollar weakness.
Yeah, that's one currency where we really haven't seen it perform as expected, right? You think in your notes that the structural weakness, though, will return when?
It's $1 million question. When does everything change? I think that obviously what we've seen is a case of the market's focusing on the potential for a hike in rates in the US faster than what the Fed's thinking about. We've seen bond yields moving higher in terms of break-evens and real yields. That's supporting the currency. And we've seen a big unwind in terms of those net short positions in the US dollar, which has all added to that US dollar support. I think that will actually continue to be supportive over the next couple of months, and that will actually hold the US dollar up, especially as we see drags to the outlook from the viral cases increases in the waves we're seeing across Europe, for example. But, slowly and fundamentally, as the rest of the world catches up and we see more synchronized growth, that will reverse over the latter part of this year. And I think you'll also see those ideas that, the structural weakness that comes with those very large deficits, the trade deficit as well with the US, should continue to reassert themselves on the currency, which is quite high in terms of the US dollar. And that will start to see that depreciation come as we head into 2022 and the latter part of this year. So I think it's going to be a period of near-term strength for the US dollar, at least over the second quarter, as that growth is going to be very strong and then bleeding out to a little bit more weakness over the rest of the year.
Kerry, do you see a slowness in the vaccine rollout in Australia having much of an impact on earnings at all?
I think the pace of vaccination rollouts around the world is one of the defining features about how we're thinking about the reopening and the reintegration of many economies with the rest of the world. We think about travel and leisure particularly. So given the rate of tourism and the importance of the economy here, that vaccine rollout is going to be quite important for allowing others to come in and for allowing Australians to travel elsewhere in the world. We might get news today of a travel bubble with Australia and New Zealand, obviously something that's been delayed many times before because of new cases that have arisen. And really, until you have a large portion of the population being vaccinated, that concern is always going to linger. So I think the pace of rollout is going to be very important for thinking about the reintegration, the tourism aspect, and the growth in the Australian market. And the fact that we have done so well domestically in containing the viral spread means that herd immunity is actually very low because we just haven't had a huge number of cases. And you contrast that with the US, where they're rapidly moving towards herd immunity on the basis of the vaccination, but on the basis they had a sheer larger number of cases. That's going to be a defining feature in terms of thinking about how Australia will perform, not just in the near term, but over the course of this year as the rest of the world does start to open up, and whether we can participate in that.
To your point, the IMF's Kristalina Georgieva last week was talking about how some countries will have vaccines, others won't. That we will continue to see this diverging economies in a very dangerous way. Do you expect to see that that divergence, that divide grow between economies that can actually get vaccinated and others don't? And what does that mean for the markets?
I think it will play through, and unfortunately, it's going to show up the most when we think about the divergence between emerging and developed markets, and perhaps some of the poorer nations around the world gaining access to these vaccines. The important part here is not just the vaccination levels, but the thinking about the herd immunity. And unfortunately, those countries that have had a high number of cases do reach that immunity, but just at a larger humanitarian cost from all those cases that have come through. So vaccination is one aspect of doing it, case counts are another. And I do think that it will be a case of thinking about the divergence and growth that we're seeing at the moment becoming more synchronized over time as that vaccine rollout does progress across the rest of the world. And that will be important for thinking about what's going to do well now in terms of how the growth plays out in the next quarter or so, how the rest of the world will catch up later on, and that rotation we expect to see in terms of asset allocation from the US to the rest of the world over the course of this year, particularly in terms of the emerging markets, which may come under pressure from a higher dollar now, but may benefit later on as that starts to reverse.